Coming to you live from downtown Detroit, this is Benzinga's PreMarket Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day.
Good morning, everybody. Welcome to this Thursday edition of Benzinga's PreMarket Prep. Spencer Israel, Joel Elconin, and Dennis Dick with you this morning. More of the same here, preparing for what looks like it'll be a down open. We'll talk about the implications of the overnight activity on this morning's market sentiment. Some of that is due to coronavirus. Some of it is due to a lot of earnings on our radar as well. So coronavirus, earnings, Tesla, got to talk about Tesla, secondary offering, can't say I blame them. So a lot to get to on our show today. Our guest, Joe Saluzzi from Themis Trading, he would join us at 8:35. In the meantime, Joel, tell us what's happening here in the overnight session.
We got some red on the screen off the pre-market lows. Opened up right near the high from yesterday. That was 81.5. Optimism on the open, 82.50. Pre-market high, all-time high. That'd be a great target on the upside. Don't think we're going to get back to that today. Pre-market low, 48.50. That's 3 ticks below my bottom level at 49.25. So I may have some more work to do here. Only possible mid-range here. See what happens at 65.5 for a lower risk short. But folks, I don't know. Your range for the day could already be in here. Let's take a look at some of the other markets here. You have crude in the red by 19 cents at 50.98. Gold up 420 at 15.75.80. Silver in the green as well, 0.093 cents at 17.59. And Bitcoin, once again, volume here today. 9,000 contracts have traded down $1.95 at 10,330. Triple D, I'm going to bring you in here, and not what you want to hear regarding the coronavirus.
No, and even regardless, like we knew they were underreporting the cases over in China, and obviously, they've adjusted now the way that they're reporting, and that's why you've seen the huge pop last night to over 14,000 new cases. I don't know why, the deaths are higher, because they said there's a new way of reporting the deaths or a new method of calculating the deaths. So I'm not sure. I would think dead people are dead people, but maybe they're like now checking to make sure, the people who are dying now, if they have the coronavirus or not. Maybe they're looking at that, but the deaths toll jumped up huge. That's concerning, and the market is down because of that. What's more concerning to me is what's happening in Japan, because there's 4 new cases here this morning just announced, and one person was found after she was dead. So they found one. I don't know if they found on the autopsy, but a case, one person is dead, and they found this that the person had coronavirus after she was dead. So how long was she? I'm not sure it was a she or he, but how long was this person walking around on the street? There's a taxi cab driver that has it now. There's another random person that just came out a few minutes ago. So they got 4 new cases from not the ship. We're not talking about the ship. We're talking from mainland Japan. So starting to spread there too, which is concerning. We know Singapore has an issue. We know UK has an issue where they're starting to get some spread. We can say we've done very well with only having this many cases, but the incubation period is so long. And I also challenge, like, they're mainly just testing people who have been to China. They're not just grabbing random people on the street and just testing everybody who's got the flu. For example, my daughter, my 2-year-old daughter, has the flu. Had the flu. I brought her in there a couple weeks ago, and she's fine now. But she had the flu, and I brought her in, and they just check her. Oh yeah, it's a flu. She'll get over it, and you go about your way. They're not just testing, they're not going to test people just with the flu. They don't have the capacity to do that. I mean, millions of people get the flu. There's probably at any given time millions of people that have the common flu. But, some of these people in certain areas could potentially actually have the coronavirus, and they're just going undetected, like this person in Japan, walking around on the street, and all of a sudden, it gets more sick and you die. And then they test afterwards, and yes, she did have the coronavirus. So it is scary. It is very, very scary, not only from a market perspective, but just from a human perspective. Like I said, I feel very sorry for all the people in China. But, the situation in Japan is very concerning. And you just wonder, you hear Scott Gottlieb talk on CNBC, and he's like doing the math on, from where it goes from a couple people who have it to pandemic. And it really took about 2 months in Japan. So if you think of, or non-Japan, I'm sorry, and China. So if you think about it from here, we probably, introduced this, less than a month ago. So we're still so early innings in North America. We're definitely not out of the woods.
Well, so the first the Chinese authorities reported coronavirus to the WHO December 31st. So, and the first cases in China were like December 12th ish, somewhere.
They're
around.
even saying as early as November 29th they're pegging it now. So it was really a month before it even got, hey, there's a problem here. It's about a month. So I don't know, and that's what Scott Lieb was, tweeting out, Scott Gottlieb, who I follow, and I think he really knows what he's talking about. He's just like, you kind of got to back up the calendar and think, okay, well, when was it first introduced into North America? Because it seems to be about a 6 to 8 week period before it starts to become a serious issue. I mean, there's no way we're at 8 weeks here yet. We're not even, I don't even know if we're at 4 weeks yet. So we're early innings here. Obviously I bought some in portfolio insurance, which was very early. The stuff I bought in June would be covered better. I'm probably going to buy more portfolio insurance. Still fully invested, still long. Like I said, I did sell a few stocks. I shouldn't say I'm fully invested. I did sell a few stocks, but some of my swing trade longs. But and I'm still market neutral.
Going back to yesterday, still long overnight.
No, I wasn't last night because I saw the big jump. So I was actually a little biased to the short side. I had been playing long overnight, but with that big jump, and obviously S&P sold off before the 8 o'clock close.
Yeah, that happened.
To the short
that helped you out, right? Did it happen before 8?
Yeah, I mean, you can, and I'm not trying to say I'm trying to make money on all this, but you're trading. So,
No.
you're trading the headlines, and that's going to be concerning. I saw short Carnival Cruise Lines last night. I mean, you're going to, think that this is probably going to bring down, some of those stocks that are obviously, right in the thick of it. So, I mean, as traders, you got to trade the headlines. You trade what you see. As an investor, I'm still partially hedged in the long-term portfolio. I went out to June. I'm going to probably buy more protection. Maybe we rally here. This market just has the tendency to shrug everything off. So maybe we rally again. Maybe I get more cheap protection.
Dennis, can we turn this into a little bit of an educational thing?
Sure.
Because a very good question here. You're mentioning the word portfolio insurance, right?
Yeah.
And we got a question here. How do you buy portfolio insurance? And that we could probably do an hour show on that. But there's several different ways to do it, right?
Yeah. I mean, if you don't want to pay premium, you can write calls. If you think, if you just think it's going to be a little blip thing and you want to take in premium, you can always write calls against your stocks. And then if it comes in a little bit, you obviously get to keep that premium. So that's actually how you can actually make money. But I didn't in this case. I actually flat out bought puts. And like I said, I rarely buy puts. Like I'm talking like this is happens once in a decade scenario where I'm going to be nervous enough to buy puts on my portfolio. But I just don't know how this plays out. And what I see in Japan now and what I see happening a little bit in the UK, it's concerning, and the markets over here are not going to get really concerned until it starts spreading in North America. You're not going to see S&P futures really start to get spanked, I don't think, until you start to see, some more cases pop up here. But we're so early. You cannot just say that risk doesn't exist. And the market is really pricing it like it doesn't exist. And I think it's an inefficiency. And that's why, when I could go out to June. So for example, what I did on my portfolio, and this was and I'm down in this, so you'll be able to buy it cheaper here today. Because when this SPY was 333, so we're 335 here now. I was able to buy the June 333 puts, so right at the money, for just over $10. I think it was $10.50. And then that gives me about 4.5 months of protection. I'm pretty sure this is going to play out one way or another by June. I bought some earlier portfolio insurance when I wasn't educated enough. In February, that's going to expire worthless. So I didn't go out far enough with that insurance. But the stuff in June, I think I'm probably pretty good there. For, it's going to play out either way. It's either going to really spread by June, or it's going to be a non-event. The market's going to continue higher. So if you just figure out 333, $10.50 costs you about 3%. You're paying about 3% for 4.5 months of protection. I don't mind doing that. And obviously, the markets even went up more than 3% last week. So, I'm glad I didn't sell everything. I'm making it back. I've already made back what I paid for that portfolio insurance pretty much from the market move here in the last week and a half. So
Dennis, why did you buy puts as opposed to selling call options?
Because the puts will protect me in the event that this is if this turns into something big. If you write those calls and you get $10 for you have 10 points of downside protection. I think this is an event that if it really gets ugly, this isn't going to be like a market falls 2 or 3%. If this really gets ugly and starts to spread, this could be a 20, 30% fall in the markets. It could happen. I'm not saying it's going to happen. I'm saying it has the potential to happen. I mean, if you start seeing people die outside of China, it's going to start to get more concerning. I mean, China's a mess. We know that it's offline, and we don't know the implications even if it just stays in China. But again, Carnival Cruise Lines warns, and they buy it yesterday. So you can see how, it's scary to be short this market too, because they just want to shrug off any type of bad news. I had Nike warned about the coronavirus last week. They shrugged it off, bought the stock higher.
Yep.
You had, obviously Carnival Cruise Lines yesterday, warning in the pre-market. They shrugged it off, bought the stock higher. They had Baba warning here this morning on, the numbers beat, Baba was trading higher, but then they talked on the call and they were warning about the coronavirus, and that's why the stock is down a little bit here. Are they going to shrug it off and buy it higher? Maybe. But eventually at a certain point, there'll be a tipping point where that buy the dip will turn into sell the rip, or that buy the dip will turn into sell the dip. And that's why I'm just hedging myself. I am worried enough to pay 3% to protect my portfolio. And I'm only partially hedged, but I'm thinking about adding to it. I'm thinking about adding more today. Maybe we buy, like I said, this market's so silly, it'll probably just buy it right back up again because it finds a way to be positive about everything. And maybe it's going to expire worthless. Best case scenario, doesn't be a contagion. My puts expire worthless. I'm still long on my stocks, and I go about my way just losing my 3%.
Real quickly, when you sell calls, let's say you're selling the 325 call here in Apple for $4, right? You're protected down to 321.
Yeah.
But once the stock falls below 321, your protection is gone. So an even more sophisticated strategy, and I think people have to have Nick on again. If Dennis, if you were really if you wanted to go a little bit more bearish, you could sell calls and then take that premium in that you're selling the calls from and buying puts. Now that you got, you're talking about risking more your portfolio by doing that, but that's what some people do. They sell calls, they take that premium in. And
you lose the entire upside, though, in that
exactly.
case. And you go to put call parity. If you're doing that at the same strike, it's just the same as shorting stocks.
Exactly.
So, so if you want to do that, you can sell calls and buy puts. But at the same time, you're just basically mimicking a short stock scenario. So, you can look up put call parity if you want to Google it quickly, but that's what it is.
Vertical collar, Anne-Marie Band is calling it. So there's a lot of different ways. And just also, we can move on this for a second. I think it also depends where you're at in your investment time,
well, it does. I mean, and that's why I'm not hedging a chunk of it, because I did go through, and believe me, guys and girls, if you've been in the markets for the last 10 years, you've never experienced a real bear market. They can say, oh, we fell 20% during this, or we fell 18%. You never experienced the financial crisis. You never experienced the tech bubble when markets fell 70 to 80%. That can happen. Believe me, it can. I'm not saying it's going to. I've traded professionally for 21 years. I make my money by extracting alpha from market inefficiencies. So the efficient market hypothesis is false. I can guarantee you it is false. The market prices stuff in, but it did not price in the financial crisis. There was lots of opportunity. Remember the Bear Stearns puts, or the Bear Stearns preferred stock that I shorted back in the financial crisis. And this was already starting to get rumors that, hey, this might be something a little more serious. And I can remember having this conversation with my wife on Bear Stearns, and Bear Stearns preferred stock was trading at par. It had traded at par for 7 years, $25, just doesn't move. It's a 6% yielder, doesn't move. And I'm like, you know what? I don't know if Bear Stearns, is going down. I don't think it's going down. But I'm like, there is a chance it's going down. And I can short this preferred and just basically just pay the 6% fee. There wasn't a lot of borrow costs back then in 2007. Pay the 6%, dividend and get a shot at, potentially that this is something big. 3 weeks later, that preferred stock went from $25 to $12. It eventually actually went back up because they got taken out, obviously, and bailed out. But it wasn't like, a move. This was a stock that didn't do anything for 7 years. I was 3 weeks early, and I was able to make a serious amount of money on that, like 6-digit money on that. And there's opportunities like this where the market, misprices. It is not counting in risk from the coronavirus at all. I mean, we're bloody up since we've discovered this. The market is discounting all risk from the coronavirus. It's saying it doesn't exist. I believe the market is wrong. And that's why I'm buying puts. Again, you can't be trading this on the short side and getting your face ripped off right now. So, as an active trader, you just trade what you've got. In my active trading portfolio, I'm probably not going to get real bearish until we get under 330 SPY. But from a portfolio perspective, I think the insurance is very cheap right now, and why not?
Also,
if you're nervous.
Yeah. Also, like we're using like portfolio insurance and vertical collars, and a lot of language you might have to do a little homework on. But someone mentioned this in the chat. Cash is a hedge. If you're worried about the market, if you're unfamiliar with option strategies, if you're not,
It is.
It is cash. Is a hedge. I mean, better than being in the market.
The reason I'm not liquidating my portfolio and going all the way to cash, though, for this reason is because if this does get contained, which we hope it does, I hope for people, I don't want to see people die here. I hope it does get contained, but and if it does get contained, the market's going to be significantly higher. The market is not going to be at 335 just hanging out here on SPY. I think, if this gets contained and gets off, you have people who are playing this from the short side, they're going to get caught. And, we could seriously be at like 360 or 370 SPY if they, because the earnings have been good. I mean, the market is moving. It wants to go. I was fully, invested rah, bull here until this coronavirus thing popped up 2.5 weeks ago. But there's a time to maybe buy protection. And when the VIX is at 14, and it is right now. I mean, okay, overnight it's going to pop up here again because we're getting a little bit of fear. But it was close at 13.7. Portfolio insurance is on the cheap side. When you look at the VIX and you see the VIX 10 to 14, it's fairly cheap. If you're buying portfolio insurance when the VIX is 30, you're paying up significantly for it. So I just see a lot of potential for problems. That's all. Potential for problems. Why not hedge myself a little bit? So what I did, people asking me, I went out and bought the SPY 333 puts for $10.50. They'll probably be like $9 today, maybe $8.50 because the SPYs went up from there. So you can even get it cheaper than that. If you want to go at the money, you're paying like $10, $50, $11. So it's fairly cheap. That's where I'm at. That's where I'm at in the long-term portfolio.
And it's also worth pointing out, Dennis, you're young enough where if the market were to crash, you have time to recover.
Well, somewhat, and when I was 23, yes. When I was 25, yes. I'm 43 now.
You have time.
I have time, but I don't want to work for the rest of my life either here, Spencer.
Right.
So
right. Oh, but
I'm hedging. I'm not hedging at all. I'm not going to hedge at all. I can't bring myself to hedge my entire portfolio. It could probably cost me $100,000 in puts. I can't bring myself to spend that much money on puts. I've already spent 10. But to hedge myself, and obviously some of this is cheaper. So I'm going to have to roll because some of this I bought a good chunk and I went with a lower strike because it was cheaper and that's going to expire. So I'm going to have to buy some out to June. I'm going to have to spend a little bit more money to protect myself. And I fully intend to do that. But I mean, it's scary when you have to come in and, I don't like paying that bill. I don't want to be buying, puts and giving up significant amounts of, a premium and paying that. But in this case, I'm nervous enough, me personally, I am nervous enough to take out some insurance right now. That's all.
And then on the other side of that, you get someone like me, to Joel's point, I'm dollar cost averaging them like a bot. I'm not even, it's literally, it's automated. I don't even do it. It's just, it's every month. So,
Did your bot sell the Under Armour or was that you?
No, that was me. I sold the Under Armour.
No, I mean, and folks too, if you're just tuning in and you've been listening over the show, over the last week or so, this is just scenario analysis.
All it is.
It's all it is. And Dennis is just looking at the factors from his, 20 some years of trading, and he is just giving you his opinion on things. You could do what you want with it, but it's just a scenario analysis, and how it plays out, who knows? But that, that's what we want to try and do. So anybody that's, whatever, taking any, ill will or towards this or anything, it's just a scenario analysis. Is really the same thing that we do every day from 8 to 9 every single day.
Nobody knows how this is going to play out. If somebody says they know how this is going to play out, just stop listening, because nobody knows how this is going to play out. It's going to play out one way or the other. It's going to become a global pandemic and a lot of people are going to get sick and a lot of people are going to die, or it's going to get contained and we're going to get a vaccine and we're not going to be talking about this in 6 months. Nope. One way or the other. It's going to be talked about nonstop in 6 months, or it's not going to be talked about at all. Either way, it's too big of an unknown for me to just throw, I'm going fully invested, I'm not going to worry about it. And maybe it's because I've went through I watched my portfolio in 2007, and this was different. The financial crisis was real bad. But, I watched my portfolio and I was in conservative stocks, and I watched it get cut in half. So whatever you made, on your long-term investments, I watched down more than 50%. But I mean, you put it in perspective, the S&P went from 1,500 and change to 666. So it's 70% correction. Markets were down 70%. So think about that. You got $1 million. We got 300 grand now. Can you stomach that? Ask yourself that. That's what you've got to ask yourself in certain instances. I see a lot of similarities. I'm not saying this is the financial crisis, but this is a big enough thing. And the financial crisis looked pretty small in the beginning too. You had Peter Schiff, talking about it, but there was a lot of people that were buying banks. Citigroup went from, $55 or $60 and was down to 50, and people are like, you got to just buy. I remember going to an investment conference. We are buying banks because we know this is going to always turn around. It always turns around. And they're saying we're buying banks. Citigroup ended up going to $1 or $2, and it still never recovered. You can say it came back. It hasn't. There was a 10 for 1 or whatever it was. What was the reverse split? 1 for 10, or was it 1 for 20 even? Never came back. I mean, the all-time high on Citigroup. What's the all-time high on Citigroup, Joel?
Oh, geez. Let's
go grab it. We're just trying to give perspective, because there's so many people have been caught, and newer investors that haven't seen tough markets. We're just trying to give
570.
570. So you held for the last 12 years since financial crisis. You're down a cool 80% on your money in Citigroup. AIG, what's the all-time high?
Well, that 570 wasn't 8 years ago.
12 years ago, 2007.
That was before that, but whatever.
2008.
AIG, get your order out there at $2,042.96.
$2,042 is the all-time high in AIG, because I see this. People say, well, AIG came back. No, it didn't. You're just looking at the dollars because it's $55. But that's not the case. It never came back. It's $2,000 because it did a 20-for-1 reverse split. You never got your money back. You're never going to get your money back. There is issues, and obviously JP Morgan came back and really did make new all-time highs. There was a few survivors there. But, there's stocks that never, ever recovered from that. There's obviously a lot of stocks that did. And, maybe long-term, we're fine. And this, I'm not saying this is going to be, the end of times and, you've got to prepare yourself. But I see similarities where I could see this turning into, if this spreads and really starts to spread, I could see the markets falling 30 to 40%. I could see a scenario where that could happen. I don't want to stomach that again. That's all. And that's why I'm buying some insurance. That's all.
All right. Let's we got Joe Saluzzi coming on here.
10 minutes.
Yeah.
We love Joe.
Yeah, we got to talk. I mean, we want to talk teas. Do we want to talk tan? We want to talk Tesla? What do we
Tesla is what we want to talk.
Tesla.
So Tesla had a 10K out at 7:14 this morning, and then about a half hour later, they announced a common stock offering. Woohoo!
Awesome. We love offerings.
They're gonna raise about $2 billion in an offering. We don't have a price though.
And always those prices matter. So once the price comes, that's obviously, so they're smart. They're using their inflated stock price to raise some more cash. Why not? Why not? I don't know if they're saying there's a reason they're raising this cash. Have they said where the proceeds are going or anything? Why? We'll use net proceeds from the offering to further strengthen its balance sheet. Okay.
Yeah.
So it's just raising cash.
General corporate purposes. Elon is participating, of course. Larry Ellison is participating. They're buying very small.
People want to buy my stock at an inflated price, I'll sell them stock.
Yep. Sold to you.
Sold to you.
And I saw Nick, he posted a video yesterday talking about the consolidation and the quietness in it. And I'm like, and I did look at it and I'm thinking, man, that would have been a good one. Because look at that. Look at those ranges after you. Oh, what happened there, Spencer?
Hey, you sound louder, Joel.
Wow.
You actually sound better all of a sudden.
Man, I do. We got to get this board fixed here. 3 days. It was like really quiet. I don't know what you could have done buying options on something like that, playing like the 800 call. I mean, you probably would have had to spend like $1 zillion, but boy, it was just too quiet. It was too quiet after it had that bump. Wasn't on Monday that guy wrote the article that was going to 1,500 and that it failed miserably off that. So you got to find out the offering price. Hard to give technicals here, but I think for you, bulls out there, you got to keep an eye on 687, and that's still $50 away. I don't know. For me, I'm thinking like 700, but who knows? And I guess Elon's buying some of the stock, and what's his name? Ellison is going to be buying some.
Yeah. So 10 million. So they're trying to like say, hey, we're going to buy, a little bit here.
We're buying
So
too.
we're still buying up here. Allison's buying $1 million. I mean, and Musk's going to buy 10 mil, 2.3 bill. That's such a small piece that they're buying. They're just trying to say, hey, look, we're just trying to give a little vote. They're trying to get a vote of confidence to it, to a certain extent, so that they don't really slam it on this. That's all that is. That's trying to give a little vote of confidence.
Okay. All right. Just look at the pre-market low here. That's just an intermediate number. They knocked it down to 712, back up at the 740 area. Let's see if I can find an intermediate low ahead of that 687. No, I can't. Nothing. I see the low on the next day was 730. So I think long-term holders of this one, I would keep an eye on 687. If 687 went by the leeway, then boom, I would look for a little bit more downside, and never got that 50% pop off that 969, that 860 or 687 low. I was hoping for like 830. I think I was just a little bit choosy on that. The highest you got was 819.99. Let's talk solar here. Solar is,
and we talked about solar yesterday as being a hot trade on the upside. Well, not this morning. SunPower is dragging the rest of the sector down here. So they reported earnings after the close yesterday. The EPS beat 23 cents versus 21 cents. The sales, however, missed 607 for $641 million. They gave some Q1 sales guidance, and it was okay, I guess. But they're smacking SunPower down, and because SunPower is down, so is most other big solar stocks. Yep.
And it's a tough day too to report, because actually last night, believe it or not, they knocked this down and they bought it back up, and it almost got back to flat, and then it started to leak a little bit, but then you get the overall market sentiment has turned a little bit here, just at least for this morning. So that doesn't help either. It's coming down. I mean, it was breaking out. I'd be more inclined, if I was buying the dip, it'd be a stock like this. I'd be more inclined to buy the dip on, but I'm not buying any dips right now, just for the same reasons that I just talked about for 25 minutes. But I think you come back in, it prices memory, has lots of support here in the mid 9s. Maybe it just goes through all that, but
yep.
I don't think this is something they're going to whoosh down to $7.
Yeah, there was also a downgrade, I believe, from Cowen on that one, but that's kind of like after the fact, Jack. Dennis is talking about this 950 area. Pre-market low comes in at 946 and kind of just been creeping up. I see a couple lows right at 950, but 3 days ago, you pierced down to 921. So, I mean, I'll just call that zone, 930 to 950. I mean, that's I think that would be the cheap area in the stock if you're looking to buy this on a decline. In order to get to the bottoms yesterday's range, you don't have that far to go. 1010. That was a low from yesterday. We're not that far away from it all because of the big rally. So I use $10 as resistance.
And then, as we said, most solar's down.
Yeah.
Enphase, TAN. I just look at JKS is down.
They're all down. Can we do some of the big ones? Because we didn't do BABA, and I mean this is widely traded.
Right over.
Sure.
Yeah, this is what everybody's talking about here this morning. And Spencer, I'll let you take it, because obviously there's stuff said on the conference call. Lots of information coming from Alibaba here this morning.
Right. Yeah. Alibaba reporting earnings. The EPS was good. The sales were good. They both beat on the estimates. Not really sure how much that matters today of all days, but the numbers for last quarter were good on the conference call. The CEO called coronavirus a black swan event. That's always great to hear. And
yeah.
So
that's scary.
Yeah.
I mean, and the stock was actually trading higher. It traded higher so it got hit because everything got hit in China overnight. Then it came out at 6:45 this morning. They blew the numbers away. I mean, they're blowing them away. $2.61 versus 220. Full disclosure, I'm still long Alibaba in my investment portfolio. Still love the company long term. Sales beat, everything beat. Stock was trading higher for a good 20 minutes. Like, it was trading higher, maybe even longer than that. It was still trading higher despite China getting killed, the market's getting killed. This stock was actually trading green. The thing that brought it down was conference call comments, which you just said, and they called, the CEO says the outbreak presents near-term challenges, and also did say that word, that this could be a black swan event. Nobody wants to hear that. Nobody wants to hear that word black swan. Google it if you want to, find out what that means. But, we're talking about events that happen very seldomly that obviously are very, very serious. So, and I call tail risk. I talk about that. That's why, I've been buying portfolio insurance, because I see a lot of tail risk here. Tail risk just being, going back to your statistics courses there, being that outside chance that, you have this, if I draw it out there for you, where you've got, and obviously a lot more risk on an event risk here. So you could call it event risk, whatever you want. The tail risk, the event risk here is coronavirus.
Tough looking chart here for the Bobster. Currently traded down 511, 213.20. 219.20. You're off the pre-market low. 3 brackets in a row. You found buyers at 216, 216 and a half. That's only a couple bucks away, so I'd keep an eye on that as a potential target on the downside. That coincides with what do you got? Any daily lows in that area? Let's see here. Yeah, your 2-day low, 215.29. This is a tough one. I don't know. If it breaches the pre-market low, then I think there's going to be much more on the downside. If they keep this bid and rally up, I don't know if you'll see the bottom of yesterday's range. Yeah, you may. 220. Let's use 220 as resistance, 216 as support.
It's scary. I'm long Alibaba. I don't intend to sell any. I still love this company. If you want exposure to China, I still think it's the best one. With that being said, it's just a tough environment to buy a company from China.
Yep.
All right, 8:35 or just about. Let's bring on our guest today, Joe Saluzzi. He is a partner and co-founder of Themis Trading. Joe, good morning.
Good morning, guys. How are you?
Doing okay, Joe. Doing okay. We're just trying to get through the, I don't know what you want to call them, the headwinds that is the coronavirus or not, because the market does not seem to really care. So, I guess, what is your reaction, Joe, of your interpretation of the market's reaction to the coronavirus?
I mean, it doesn't surprise me, and I've been watching Dennis's tweets online, and I feel, the market is, and I feel the same way, by the way, how it can just totally ignore something which could be so big. But I think what it does see is, first of all, there's momentum in the market, right? And second of all, you got the Fed in there, and when the Fed's in there, it kind of mutes everything else. But when it comes to something like this, which is kind of still unknown, it could be looking at it as, well, this is a temporary effect. We know there's going to be a problem in China. The GDP may even be negative for a quarter or something like that. But the market then says, well, if it's not a long-term thing, well, we'll give it a pass for a quarter. Where I'm kind of worried is, well, what happens if it's not just one quarter? What happens if it's 2 quarters? What happens if it spreads to other countries? What happens if you start to really, disrupt supply chains around the world? Well, now you've got a much bigger issue, which could, act as a derailer to any sort of momentum market. So we'll see. I think the jury's still out there. I think a lot of people on the last downtrend that we had, which was about 3% on the initial fears of the corona, maybe people got short, maybe people tried to lean on it, and then got whipsawed on the back on the upside. So it's something to watch.
I think that's exactly what happened, Joe, because we had the big whoosh there on that Friday when we were down 600, and people are like, oh, we need to get out. And you have people selling, and you have people, selling short. And, and I was one of them too, not selling short, but I bought puts, and my puts were looking pretty good on that Friday. And those puts are going to go off the board worthless because I bought some FEBs, and those are going to go off the board worthless because I didn't go out far enough with the protection. I was smarter the next time. I went out to June, so I want to give myself some time for this thing to play out. But I mean, I totally believe that we squeezed a few people, and that's what drove us to new highs, that you squeezed everybody who was selling it that day. And I'm talking, if you're looking at your chart there, I'm talking about the 31st there when we hit that low on the SPY, and we've been straight up ever since. Are your clients worried about this? Are you hearing anybody talk about this really? And what I'm just wondering, what the perception is there where you are.
Yeah, we're not actually. Our guys who are more generally focused, let's just say macro level hedge, mutual funds, pension funds, and so on, who are longer term holders, we're not hearing much from them. And then just people I've spoken to around the street, not necessarily clients, some are saying that, well, you know what, this market's riding. I don't want to buy it here, but I don't want to sell it either, so I'll do nothing.
Yeah.
And I think that's what you're seeing a lot of, kind of this ambivalent, let's let it run and see what happens, because I don't want to miss out on another 10% upside if we keep moving. But in the meantime, why should I buy it here? It's kind of expensive. And I think that's why the volumes are not necessarily huge that we're seeing lately, and they're kind of muted, and it kind of supports that point of, hey, we'll do nothing for now until we can actually see where this thing is going.
I think, and from what my perspective too, is every person that I talk to, obviously not the people who listen to the show, but I mean, just talking to friends and, and going around talking to different people, I always get the same response. I'm like, are you following the coronavirus thing? And it's like, yeah, isn't it just like the flu? Like, I mean, 9 out of 10 times I'm hearing this. And this is what's being, said in the media too to us. This is just the flu. And I've been trying to say, hey, look, the flu is one thing, and yes, it kills more people than the coronavirus has, but the flu doesn't kill 2 to 3% of its people. It kills 0.1%. So like 3 out of 100 people aren't going to die with the flu. And it's usually the people who are dying are older people, not, we've seen obviously some deaths here where, the Chinese doctor is 40 years old. So it's a little bit different animal. So we're kind of comparing apples and oranges. And sometimes I explain that to other people and sometimes I just, but that's kind of the perception out there. And I do believe that's why the markets continue to go higher too, because everybody just thinks, oh, it's another flu bug.
But they should be concerned of the unknown part of it. And I think yesterday proves the unknown. All of a sudden, 15,000 new cases pop up, which means we cannot trust. Obviously, most people know this. You can't trust the news coming out of China. You would like to have some more international folks going in there, the WHO organization and whatnot, to kind of get a real grip as to what's going on here, because it's not just a China story for them. This thing obviously could infect the rest of the countries around the world and so on. So we really need to find out what's going on, but you're not getting that information. And that, if anything, if I would, as an investor, I'm more scared of volatility and the what is it, the unknown unknowns, right?
Yeah.
And that's what's going on here. But people just will shake that off. And you got the Fed yesterday saying we'll support the markets and put the money in. As if there's any downtrend, we're there for more QE. I mean, really? Are we still doing the damn QE game? Are we still doing this backstop 12 years after the financial crisis? It's unbelievable.
Let's talk the Fed. I mean, Powell was saying the same thing, and it's on their radar. And it sounded like he was ready, to press the button on lowering rates if needed because of the coronavirus. I mean, here we are, the markets are trading all-time highs. Interest rates are already at a very low level when you compare long-term where they've been. And he's ready to lower them again. What are your thoughts here on just the Fed having the markets back?
They are pure addicts, okay? They're addicted to free money. Ben Bernanke was the king of all addicts. He started this thing, and the rest of them are just following along because there's no way out, right? There's no way out of saying everyone's afraid of a downtrend, but in the meantime, markets need to go where markets need to go. But there will be a day of reckoning, of course. We don't know when. It could be 10 years, 50 years. I don't know when. But you can't just keep pumping money in for free, right? And this is not just a U.S. phenomenon; it's a global phenomenon. And look at the 10-year Greek yields, right? Less than 1%. Would you own 10-year Greek bonds for less than 1%? I wouldn't. Okay, but that's just a symptom of what's going on here. So I don't know when it's going to stop. I don't think it will stop anytime soon because people are just, right. So when it does stop, when the music stops, how many chairs will be left, right? What was that? The Citibank guy a couple of years back in the financial crisis? It's a scary thing, but I think the market right now looks at it as saying, they're not going to stop. So why should we stop? Why should I stop? I'm going to underperform if I don't keep buying here, if I'm not invested. And I get it. I mean, you're a market guy. I'm a market guy. I'm not going to fight it. Do I trust? Do I believe in it? And do I agree with it? On a global perspective, absolutely not. But why would you fight it? And that's where a lot of people are.
We're on the line with Joe Saluzzi from Themis Trading. Joe, always great to have you on the show. Back, I believe it was December 2017 when we did our Bitcoin special. That was 17, right? And we had experts such as yourself on the show. We also had Professor Jim Angel, Peter Schiff, and at that time there was, we did have some bulls on there, but it was pretty well overwhelmingly bearish response. And it coincidentally topped out around 20,000 at that time. Now a prolonged decline. You're seeing a rebound here. Is this, can you talk about the fundamentals behind that? I see increasing volume coming into the Bitcoin futures, price going up. Like I said, Edwards and McGee taught me that's an uptrend. What do you think? What's the next move here for Bitcoin?
Yeah, I don't know. I'm not going to pretend to comment on that. I would know the price of that, of
Right.
Bitcoin. It's an interest. It hasn't gone away. Which I will say is, 3 years after we talked, or 2.5 years, whatever it is, it hasn't gone away. Which tells you that there is staying power, right? There is something there. People want to own this. There is and I think it's fine. I mean, I don't have a problem with an alternative asset class. My problem's always been about regulation and how you have to make sure the markets are at least somewhat fair. And from what I can see, there hasn't been any movement when it comes to really putting some serious, adults in the room when it comes to regulation. So for that reason alone, I stay away from it. But if they ever do get to a point where it looks like a legitimate market, well then, you know what? An asset is an asset. If you're buying baseball cards, right, gold, crypto, I don't care. If there's a valuation to it and you think it's going up, well, go ahead and buy it. Right, but if there's a negative case to it, then that's the other side. I mean, it could be getting some movement here, also obviously with the China fears and people looking for some sort of alternative class. Makes kind of sense.
And you're just taught, you mentioned like your order flow, like you see it coming off the desk. You said they're not really selling, because you don't want to miss out on the next great move, but they're not really buying either. So what do you think they, would tip the scales, one way or another, like a worsening of the virus, or because institutions, I mean, they move money around a lot. There's a lot of rotation. What will get them out of this wait-and-see approach?
Right, and I should clarify. I mean, we see both here. I mean, we're agency brokers, so we're trading on behalf of clients. So I do see buying and selling all day long. It's not like, but I'm not seeing position taking by hedge funds and so on. Those aren't necessarily our clients, so I don't have a feel for that.
Sure.
People I've talked to, or not, like I said, not necessarily clients, have that kind of more of the professional trader types are saying, yeah, why would I get involved here? Why would I sell it? Why wouldn't I buy it here, and so on. So what we're seeing on a daily basis is our regular flow that we've seen for 18 years now with Themis trading. We buy them, we sell them, we pair positions for folks, we leg in for them. Our job is to get in there as quietly as possible, making sure nobody else sees us so they don't run the price up or knock it down if we're selling. And really, from our perspective, nothing's really changed over the last couple of years. It's flow that we normally see, and the flow is still coming in, and we do our thing. But we're I wouldn't use us as a good litmus test, because we're not your typical Wall Street firm, because we are just agency only, and we're not committing capital. So it's a lot different here. Yeah.
What about time to time ask you about the IEX? How they doing over there? You sending more order flow there? Where they want to be a couple of years after being in business?
Yeah, I'm glad you actually brought that up, because there's something, of course, there's always something controversial going on. And the newest topic, IEX just came out and proposed something called a delimit order type, which I think you'll like. And we support it. We actually just wrote a comment letter to the SEC supporting it. And what this is, and think about the term latency arbitrage that we've used over the years, which is essentially an HFT picking off a stale quote. So you're sitting there bidding for stock, you're in a long line of other folks, and you're waiting for you don't want to cross the spread, and you finally get filled just as the stock's about to roll over. Happens a lot. So IEX said, let's come up with a method to try to protect that investor who doesn't want to get that fill when the stock's going to roll over. And they've used some sort of their technology, which is called CQI, which is a crumbling quote feature, which figures out when the quote's about to move. And rather than leaving you there, sitting you there and about to get run over, it will move your price down a tick. So essentially, it's a lit order. They currently have this technology for non-lit orders or non-displayed. But now they're proposing to do it on a lit basis, which we think is great, because essentially it will level the playing field for a regular investor versus an HFT who spent millions of dollars on technology to build this system to pick you off, right? So It will allow you on a voluntary basis, you don't have to do it if you don't want to use it. It makes total sense to us, but now it's in a comment period. And just like everything on Wall Street that some of the bigger folks don't like because it may upset their model, and some of the HFTs may not like it because they can't pick off the flow that they've been making money off all these years, they're writing comment letters against it. So there's a battle shaping up. And here's our newest, fight that we're taking on, and we're going alongside our friends at IEX saying this is a good thing. This delimit order should be approved. It's here to help everybody, and the only people who don't seem to like it are the ones who are trying to pick off the stale quotes. So I would urge your listeners to take a look at it. If the comment letters are out there, and look at both sides. And if you feel the other way, then write a comment letter the other way. But the more the SEC hears, the better.
it's trying to reduce the adverse selection risk, which is, prevalent in this market. Like I've talked, we got our traders at Bright Trading, and most of our traders, if you looked at us 20 years ago, we were liquidity providers. We would be willing to sit on the bid or the offer, make a market and try to make the spread. And we're providing liquidity to the market. So the market thickens up, and these are human beings. So yes, we had some algorithms too, but they're not super fast, the algorithms that are jumping all around. Obviously just trying to avoid getting picked off. So it's a little bit of a different game there now. But our traders have moved primarily from liquidity providers to liquidity takers for the reasons you're citing, is that if I throw a bid or an offer out there, the only time I'm getting done is when the quote's rolling over. And so I'm getting basically picked off. And what we mean by the quote roll is when the bid is becoming the ask, or the ask is, going to become the bid. So that's the quote roll. So typically what happens is the investor is usually at the back of the queue. So you're only getting done usually, and we studied this at the CFA Institute. I studied this. I actually was part of the study with Svi Rosa from the CFA Institute. You can read about it back from 2017. And what we discovered in that study was that the lit quote, the quote that's out there that you see, is primarily getting transacted against only when it's about to roll. So you see all this off exchange stuff happening, and then the quote rolls and they pick off all the quotes, and then the bid becomes the ask and everybody gets picked off. So you really have the only people who can provide liquidity in this market are the same high frequency traders that are picking off the quotes. So most of your liquidity out there right now is all high frequency liquidity. So anything that they can do, any type of order type that they can do to incentivize other types of participants to provide liquidity, I'm all for it.
Absolutely. And then, Dennis, think about what you just said. If most people aren't lighting up quotes because it's pretty much toxic out there and they'd rather go to the dark, what has happened to the limit book? To the limit book, which is supposed to be a diverse order book of traditional flow, short-term flow and so on, it's gone. So it's emptied out, which gives you more potential of problems when volatility does happen. So like you just said, anything that can help increase liquidity is a good thing. And I think they've proven it at IEX. Actually, in their documents, they show why this, in certain times, how the quote rolls. And it's actually only a few minutes a day or a couple of milliseconds when these things happen. And they noticed it right away because of that indicator that they created. And they said, if we can fix just a few of these problems during the day, it's going to enhance liquidity, which is a good thing for price discovery. So just like you said, I think it's, it will help. And hopefully, folks who hear this, write a letter. Let's get this thing going.
All right. Joe Saluzzi is partner and co-founder of Themis Trading. Joe, thanks for the time and have a good one.
Thanks, Joe.
All right, guys. Have a good day. Good luck out there.
Thanks, Joe.
Joe.
All right. Take care.
All right. Let's get to some earnings here. We only covered like one or two. Let's do.
Let's rip.
We
do Cisco?
Let's do AMAT
let's
first.
do AMAT.
Okay, sure.
Yeah, let's do Applied Materials. They were yesterday after the close. The Q1 adjusted EPS was good, 98 cents versus 92 cents. Sales were also good, 4.16 versus $4.1 billion. So a beat and a beat last quarter as far as the guidance that they gave. The adjusted EPS that they gave was higher than estimates. The sales guidance they gave was also higher than estimates. So strong guidance to go with strong earnings for AMAT.
The chips just remain hot, and we've seen this again and again. I did sell my Micron yesterday. I couldn't resist. The anxiety guy who was driving the bus won. I joked about him. People were finding that pretty funny about how I was like talking about the Herman's head. But anyways, I looked at it, and I was like, the 60-61 area was a major resistance back in 2018. It's cyclical. I couldn't help myself. I sold my Micron yesterday. But anyways, the Micron's trading down slightly here in the pre-market, but its chips could turn around here to Applied Materials, and I'm still long my NVIDIA, so I still have that one. So I've still got a little bit of exposure there, but this has been an unbelievable mover. I mean, really, when you put it in perspective, really, and we can go look at the Applied Materials chart, beginning of 2019, the stock was $30. Here we're a year later, it's 65. So we've come full circle. Applied Materials kind of the same thing, looks eerily similar really to the Micron. Early 2018 tops out of 60, gets cut in half to 30, gets her all back, and now you're up here at 66. You're coming in investing it now, or is this cyclical? Yeah, it's cyclical. We don't know where we are in the cycle. Maybe it's going to continue. Maybe the party continues for a while here, but I'm not investing in it up here. Trade still looks good, though. The trend is still your friend.
I'm looking at this. I'm looking into AMAT trading at a new all-time high, up above.
Is that all-time high?
Yeah, it is.
Did you go back even to the year 2000? Did you go back to 2000? You can always go back. Whenever you look at the chart, you look at 10 year, you're like, oh, new all-time high. But then you go back to 2000, you're like, Yeah. That's how crazy the tech bubble was back then.
Now it broke out. 55 was the high during.
55 was the high back in 01. So here you are. You held for 20 years. You're up $10. Congratulations.
But I mean, you guys are going to probably think I'm crazy on this one, but pull up the pre-market chart from Lyft yesterday, please, because I totally got this one wrong.
Oh, me too. I thought it might find some support at 50-51. Nope.
No, 51. I was like, it was just eerily quiet there, and I'm like, well, someone's supporting it here at 51. I didn't look at
they
the
stopped
fact
supporting it.
that someone was selling it at 51 too. So
oh yeah, whenever there's a buyer, there's a seller.
Exactly.
The seller won.
Yeah, exactly. So so using that example for the AMAT today, it's just so quiet here. Look at this consolidation, on the 15-minute chart, going back since it reopened at 466.5, like to 67, just chopping. So, go with the momentum, breaks above 67, boom, 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 higher prices ahead. It broke below the 66.5. You might see some profit taking, but just using that analogy from yesterday, looking at AMAT there, let's see what happens. And this is just for the short term today. If you're a long-term holder and you got a target at 75, then stick with your target, stop or whatever. I'm just looking at the after hours and the pre-market trading, noticing the consolidation periods can be more important than, spike highs and lows. S&P's making back.
Buy the dip always seems to matter.
Look at all those green candles.
They aren't worried about anything I'm talking about. That's why puts. I think the puts is the best way. I can stay fully invested, participate in the rally, and I can sleep at night. I think the puts instead, like flat out short in stocks, is not the way, obviously, because that just keeps like Joe was saying. That's what really propelled this rally, Joel. Everybody on that day was selling, and then they're selling short, and they got spanked. And I was bearish, but I bought the puts. I got spanked a little bit. I'm obviously my 220. Everything I bought at 328 SPY. I think that's the 325 I have. That's going to expire worthless. I mean, I have 2 weeks left with it. The odds of that coming back in the money are probably pretty slim. But I mean, people were flat out short in stocks. And if you were flat out short in stocks, you lost a lot more than 3%.
You sure did. Let's do.
Maybe not. Yeah, it lost about 5%.
Let's do this. It depends what you're shorting.
That's what you're shorting, exactly.
Let's do the Cisco Kid. I think. I think we both own this one, don't we?
Oh yeah, horrible. This has been a horrible investment here. I had hopes for it this quarter. I was going in. I was like, maybe they're actually going to say something okay. The hopes are all completely dashed here now this morning.
Well, the numbers were good. They beat on their earnings per share by a penny. There were slight beats, slight earnings per share beat, and slight sales beat. And they also raised their dividend by a penny, from 35 cents to 36 cents per share. So the numbers were good. What they said on the call wasn't great. They said orders for the quarter were down 6%. There were some other things, but the numbers themselves were fine. They were slightly above expectations. I just think maybe they weren't wasn't enough of a beat.
In any regard, the stock disappoints here. Once again, investors are using the opportunity just to sell the hell out of it. I don't know what to say. I've got in the long-term portfolio. I'm in from around 50. It got back there. I was basically even yesterday at, this time yesterday, or actually at the close, and it's all, I'm down in this investment again. So it's a long-term portfolio. It trades at a cheap valuation, but I guess it trades there for a reason.
47.30. That's your last print, down 253. That's a big move for Cisco on the downside, but you know what? Not really like showing signs of bouncing here. Boom, 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 going to the 15-minute chart. Pre-market low, 47.11, 19 cents above that. Switching over the dailies here, man, you had a lot of error between 46 and 48.5. So if that breaks that 47.11 low that coincides with the February 4th low, you got a little open area up here down to 46.21. So for the bulls here, you better defend that pre-market low at 47.11. Daily low also there from February 4th.
I want to do TripAdvisor next.
Okay.
This has been something I've been watching just because it is a travel stock.
Yeah.
And wanted to see what they say. I don't actually know if they said too much. I didn't get a chance to listen to the call, unfortunately. The numbers yesterday were good. Their earnings were good. EPS beat, sales beat. and the stock is higher, at least last I checked. But this one just is interesting for how it relates to coronavirus. And if you've looked at a daily chart, you've seen this just step down seller, but very interesting to see how this one has been reacting to the coronavirus, because it is a travel company.
Stock trading higher on the report, trading higher last night as well. It's one, I guess this has been like the dog of the group, right? Because I always put the three of them together: Expedia, TripAdvisor, and Booking. And when you look at the long-term charts, BKNG, it's not that far off the all-time highs. We got the all-time at 2028, 1960. You're off like maybe 10, 12% from the all-time highs. Then you go look at Expedia. It's off a little bit more, 160. It's off 50 points. It's off about 25% from the all-time highs. Then you look at TripAdvisor. TripAdvisor was $111 and it's 30. I mean, you're talking about a stock like 75% off its all-time highs. So obviously, this stock has been the dog of the three. I don't know if that changes, if there's a catch-up trade here eventually or not, but this isn't the type of environment that I'm looking for, the catch-up trade here. So resistance up here around 32. We'll see what happens today, but hard to get excited about this stock.
On the headline number, someone got real excited, took it up to 33.40, and boom, boom. A lot of volume traded on that bracket as well. Then you've kind of settled in. Sellers at 32. I'm looking at the dailies here, and since it had that real bad day in December, your high of the move has been 31.67. 30, and that was flanked by a 31.65 high and a 31.40 high. So to me, it's opening into resistance here at 31.65. And I think even if you get through there, you find more sellers at 32. Long consolidation period. Don't know if this is a good enough report, like to get this thing like 32 bid, 32 and a half, you get back up to 30.
It's tough too. It depends. I mean, if we shrug off, and we've seen this trade happen, the last few days where we're really shrugging off the coronavirus fears. Obviously, overnight here we've had some bad news, but really this market is still kind of shrugging it off, and I wouldn't be surprised if it does it again. Look at Las Vegas Sands. I mean, this just shows you how crazy this market is. The stock is just ripping. So since that low, when the casinos are shutting down and it's all going to be ugly back on 27.61 to 71, Las Vegas Sands straight up, and it was trying yesterday to approach the highs, which is incredible considering what is happening over in China, and a huge chunk of the revenue comes from there. When Resort's the same, it's got over half of the losses back from the coronavirus. Like TripAdvisor, Expedia, Booking are all not as direct hit, but people are a little hesitant on, should I go traveling, where I want to go here? I definitely don't want to go to China. Do I want to go anywhere right now? I don't want to sit in my home for a couple months. This is kind of a little bit, and the airline's the same thing. It's a little bit of a coronavirus trade where people are going to be nervous to own these stocks or people might want to not own these, or people might be nervous to book a trip, which could hit the bottom line on some of these companies coming forward. So all depends on what happens. It's the wild card out there, but this is also a coronavirus stock to think about.
And then speaking of those types of names, MGM yesterday actually reported earnings, and they withdrew their guidance because you don't know.
They don't know. Right. And they have a lot less exposure than Wynn and Las Vegas Sands over in Macau, but they don't know how this is going to play out. Nobody knows. Nobody knows how this is going to play out. Nobody knows. And MGM also, also reported, which is the bigger issue, is that they reported a cash tender offer there. So it looks like, and I haven't read about this, but it looks like a Dutch auction, maybe 34 to 29. So they're looking to purchase more shares, but they're looking to do this significantly under the under the price. I don't know who's going to tender those.
That was this morning. So the earnings were yesterday. Then this morning, about a half hour ago, they announced this cash tender offer that they're.
Well, they announced a buyback, a $3 billion buyback last night. They announced this. They raised the quote. They did everything right, and then they did this offering, and the stock is trading red. I mean, the stock did give it back last night too, and you also had changes too coming. Did you not have CEO step down?
Yeah, CEO step down. Yep.
Yeah. So all kinds of news here. There's so many balls getting thrown in the air here. I don't even know how to juggle those balls. I'm just out. I'm not going to trade this.
Yeah. Lots to say on MGM. Joel, did you want to look at the chart? Because
man, you guys are like, got me in a fast.
There's a lot going on there.
I know.
They're trying to repurchase 25 billion. Looks like a 34 to 29. So not more than 34, not less than 29. So they're trying to buy it under the current market price. So
opening, let's see here. You're currently trading at 32.
So it's a buyback, but they're only buying it if it's within a certain range.
Well, they announced the $3 billion buyback, and then they announced this morning they're trying to buy $1.25 billion worth of stock. So maybe part of it looks like part of the buyback they're trying to buy below the current price. So that's interesting.
Yeah.
Usually you see these Dutch auctions, you usually see them above the current price because they got to give incentive to the people to tender their shares.
They're going to buy between $29 and $34.
Who's tendering their shares at 29? The stock's 32.80. So nobody's tendering there. Maybe tender them at 34. I don't know. You got trouble buying it below, unless we really have an epic collapse in the price of MGM. I don't know who's tendering the shares at $29. I wouldn't. All in the open market.
Effectively, we're down 85 cents. We are trading. Where are we currently trading? We're trading at 32.81. So man, this thing's got to get back over yesterday's low. It's got to get a 33 bid. Or I see us testing your 2-day low of 32.24, but your super extra major support comes in.
I like it when you say super extra major.
At 31, you got a double bottom at 31 at 22 and 31 in a quarter. 9:03 here, Spencer. We're keeping you overtime.
No, that's okay. I had one question I wanted to ask. It was from a listener, but we can always do it tomorrow.
Sure, let's do it now.
We'll do it now. Okay. So this goes back to our conversation earlier, but it's a great question, Dennis, to your point about how newer investors who haven't been in a bear market. Let's say we do go into a bear market for real. Like, let's just pretend. What would that do to the liquidity and spreads?
Widen significantly. So, and your volatility. So just, you want to see, and bear markets are altogether different. So you have bear markets, and then you could talk like the financial crisis, which was your bear of all bears, when the markets fall 70%. Your spreads widen significantly, your liquidity drops significantly, and your VIX spikes. The VIX, believe it or not, during the financial crisis at one point in time, got up to 90. 90. So you're talking about, the volatility in the stocks is 4 to 5 times as much. As a trader, I love that environment because you have more volatility, there's more inefficiencies, there's more opportunity to profit, there's bigger moves. So, I actually had my best trading years during the financial crisis because there's just so many inefficiencies. I'm an inefficiency trader. I trade market neutral. So market going down, from my trading perspective, market going down, market going up doesn't matter to me. But I will say I do better in down markets than I do up markets from a trading perspective. From an investing perspective, I can remember during the financial crisis, it's like, I made a whole bunch of money trading today, but I watched my portfolio fall even more than I made. I was like, I worked my butt off today. I kicked butt trading, but my long-term investments fell so much. And I lost more of my long-term portfolio than I did trading. So, that's why I like up markets for the longer term perspective. I like to make money on my long-term money as well. But from a trading perspective, when you get into these bear markets, you get into environments like this, the spreads get wider, the liquidity, and if you're trying to get in and out of stocks, you're paying more basically. There's a lot more volatility.
Yeah. Also, though, I don't know how active everyone is, but put orders out there. I mean, I know there's wider spreads and everything, but
in that environment.
Yeah. I mean, if you trade 1,000 shares, maybe trade 500 shares.
Because you're making so much more, you might want to, and we're not in a bear market. So we're just saying, we'll have lots of time to talk about this type of stuff and the scenarios if we actually get into one. We will be in one once again. One will happen, whether it's the coronavirus, whether it's some unknown, whether it's financial crisis part 2. I mean, eventually there will be another bear market. I know it seems impossible with the Fed at its back, but the Fed, is trying out the markets back in 2007 and 2008 too, and it obviously did succeed in the end, but it was dicey there for a while.
All right, 9:06. We really kept Spencer.
That is quite all right. It was a good question I wanted to get to. If you missed any part of our show, you can always catch our podcast or rewatch the show on youtube.com/BenzingaTV. Thanks to our guest today, Joe Saluzzi, and thanks to everyone in our chats on YouTube and premarket.benzinga.com. Want to remind you all about the upcoming Benzinga Cannabis Capital Conference, end of the month, February 24th and 25th in Miami. To learn more, go to benzingaevents.com. You can always call us, as that person did, 494-0246 or email us premarket@benzinga.com. Please remember, as always, that all the information from our show is meant to be used as informational purposes only, not for investing or trading advice. Everyone have a great rest of your Thursday. We'll be back with you tomorrow.